I invite you to come check out the Your First Stocks Challenge, which we will go over 5 days. And by the end of that 5 days, you will have a complete investment strategy and you will have purchased your first stock and you'll be on your way to the path of financial freedom through stock market investing. If that is of interest to you, I invite you to go to yourfirststocks.com and register for the free 5-day challenge today. Hi, it's Dre Griggs with Obscene Wisdom. Today we answer the question, how do I start investing in stocks? We have each heard along the way someone telling us how important passive income is, and passive income is important. It is the only way that you can guarantee you won't have to work for the money that you need to live your life. We call it financial freedom, we call it retirement, we call it by a bunch of different names, but we just want our money to be able to sustain our lifestyle without us having to give our time for it. Now, some of you may know someone who has been telling you, hey, you should invest in real estate, and others maybe talked about Bitcoin or cryptocurrency, different things, but I'm going to show you the tried and true way to start investing and generating your passive income, and then you can take that money from the stock market and you can invest some of it in real estate later on. The entry fee is much higher when you talk about investing in things like real estate. And while, yes, you can leverage your money in the sense that you put 20% down and then when you sell the property, it is at that 100% amount, you have to have the 20% down. And so I usually tell people, if you don't already have some passive income being generated, I think the stock market is a fantastic place to start. You will find that about 80% of the money in the stock market is put there by the top 5% of wealth in the United States and in the world. There has to be a benefit of investing in the stock market. So today I'm going to show you how to get started. The first place that you want to get started for your investment journey is to go ahead and set your investing philosophy. What is your view of the stock market? Do you think that it's something that you enjoy crunching numbers? You're going to go on every single day. You're going to be following all the trends and you think that you want to be very active? Is it something that you're looking for a little bit more passive and you just want to know where can I put my money and kind of leave it alone? And when I come back, I expect to have some sort of a consistent return. Are you terrified of the stock market where it's going to keep you up at night and you just want to have something safe to get you started, get your feet wet so you can be comfortable enough to be able to put your money and leave it in there? There is no benefit to investing in the next hot thing if as soon as the market starts to have a small downturn, you immediately are going to sell your stock. If you're going to immediately sell it, then you're going to lock in the losses. You have to be someone who is comfortable leaving their money in even when the market isn't doing well. If you're not that person, then you would create a different investment approach, but you have to start with your investment philosophy. Your investment philosophy is, do I want high growth stocks that maybe have a little bit more volatility, depending on your investment philosophy, goes up and down, it's okay. Over the long period of time, it should go up if I picked a great company. Or are you someone that's looking for a little bit more of your asset protection? We call that maybe value investing, where you invest in great companies that don't have the highest growth rate, but they are consistent. They're always going to be there. You may even get dividends from stocks like this because, again, they're not focusing on growth as much. And as a result, they find the best way to spend their excess profits is to give it back to the shareholders, which is you. I will show you, depending on your investment philosophy, 5 different approaches to finding the perfect stock for yourself. The first step is creating that philosophy. You have to know your risk tolerance. You have to know how long you want to leave the money in because that will determine where you put your money at. And you have to know overall how invested you plan on being with your investments. See what I did there? Once you know that, the next step is, what is the goals that I have set for myself? We're not just trying to generate the money because we just want to be Scrooge McDuck in a big old vault where we just swim in the money. There is some type of a lifestyle, some sort of a dream life that you're looking to create, and we need to figure out how much that lifestyle costs. Do you want to go on trips? Well, how much do you plan on spending each month on the trips? Is it going to be a monthly trip or an annual trip? So how much do you want to spend each year? Are you going to pay off your house? Are you going to move somewhere? Do you want your kids to go to college and you want to pay for that? Do you want to quit your job and go for your passion project? Do you want to start a nonprofit? What is it that you want to do? Or are you just looking to get out of debt and you just kind of want to keep it nice and easy and have a pretty low profile so your number may be a little bit lower? Whatever that dream lifestyle is, you have to set your goals when you're creating your investment philosophy. You have to be able to say, this is how I feel about investing emotionally. That means I have to have a certain approach with my strategies. I then have these goals, and this is how much they cost. So this is how much money I need to fund my lifestyle. Financial freedom is different for each of us. It may be $1 million over here. It may be $10 million over there. It may be $30,000 a year. It may be $30,000 a month. Whatever your goals are, we have to know the amount of money that we need and how long we have. Do we have 5 years? Because if you want 5 years and you want to hit $1 million, you probably got to invest somewhere around $500 a month to be able to hit that number in a 5-year span with about a 10% return. That's about the average that people get in the stock market. If you have 40 years where you love your job, you love everything about your life, you just want to be comfortable, you can actually do that with about $5 a day, which is about $140, $150 a month. With about a 10% return, you will get that $1 million. Those are people that love what they're doing and they say, you know what, sure, I don't think I can do it forever. I would love to be comfortable enough to know that if something happened to me physically where I didn't want to work, or maybe the company was sold, there's a change in management to where I do have that nest egg to make sure I retire. And then everything in between, you have it there. So you have the about $140, $150 a month if you want to be around the 40 years. And then if you do about $500 a month, you could be done in about 5 years. Now, granted, I can't guarantee anything because the stock market doesn't give us guarantees. But depending on the amount that you have, we can decide exactly how much you want. Once you know how much you need, the third thing that you want to do is pick your asset allocation. If you're wondering what an asset allocation is, it is simply what is the asset that you have that is generating some sort of a profit, some sort of a revenue, some sort of a value to you, right? You have assets and then you have liabilities. Normally, when you're looking in the stock market, your assets are going to be usually stocks, they're going to be cash, they're going to be bonds, and they're going to be some short-term investments, and it may be foreign investments. So you have domestic, which is here in the US. You have international, which may be across overseas, your foreign investments. You will have, usually those will be your assets. There is a certain level of risk and a certain amount of return you can expect from these assets. Now, granted, in each of these categories, you can break it out in a variety of ways, where in your stocks, you could say, do I have large cap companies, which is normally companies over about $10 billion in revenue. And then you have small cap companies, usually around $100 million to $2 billion in revenue each year. And then obviously your mid caps is in between that. That's like your $2 to $9 billion. And then you have your penny stocks, which we're not going to touch. You're not being crazy. But usually I would say, look, don't go below $100 million of annual revenue. Those companies generally have better financials, which we'll go into later on when you're determining the value and the reliability of that investment. The problem with some of those very small companies where you're doing the penny stocks and trying to make it work is they can almost just lie on their numbers. I mean, I'm not going to say that they're lying because I don't want anyone to send me a letter, but I am saying that they fudge the numbers in a way where you don't have the proper information. You can't make the best decision. And the best example of this is you and I both know that the people who are in Washington, D.C., they have a very wealthy portfolio. Well, why is that? They have the information necessary to make the best decision about where to invest because they have the oversight on those companies. In other words, if you're able to get the right information, you and I can also determine whether something is a good investment. Think of it like Shark Tank. When on Shark Tank, someone goes on and you'll hear them. They'll say, okay, what is your turnaround time? What is your cost? What is your lead time? What is your accounts receivable? They'll say, what is your number one product? How much does that cost? How many units do you move each year? They're asking for the information necessary for them to determine if it is a good business to invest in. You and I will do the exact same thing. We are sharks choosing companies to invest in. And there's certain information that we need to know for us to be able to decide, is this a good investment? And just like the sharks in Shark Tank, they often stay within a certain brand in a certain industry because they know that well. Damon Johns, you always see him use things that have to do with fashion and consumers. And then you see that other ones will say, okay, well, it has to make sense for my food industries. And then other ones will say, well, if I can put it on QVC, then I know that that is a great one. I have certain, revenue streams where we can cross-sell and it makes sense. So everybody, when you watch Shark Tank, it's not always about whether it's a good business or a good investment. Sometimes it's about, do I even understand what they're doing? Which is pretty important for you and I as well to decide if we want to invest. So when you look at the asset allocation based on the number of years that you said you have out and the amount of return that you overall will need, you will decide what the percentage return you need is. If you need a 5% return, then we can be in a pretty conservative asset allocation where the majority of your money will be in bonds. When a bond is just as it sounds, it's debt. Normally it's the debt from either a very reliable company or debt from a government of some kind. Governments aren't going anywhere. And then you expect to get a certain return each year. And based on that, you can say, okay, this is the amount of money I need. If I can get like 5%, 4%, then I'm good. If you are someone who has more time and you feel like you can deal with the risk and the ups and downs, but maintain the discipline, then you can invest in small caps. Small caps generally outperform large caps. But the problem is small caps are more volatile, where if something happens in the economy, it will freak out a lot of the smaller caps because it hits them a lot harder because they ride the ebbs and the flows. But if you have a larger company, they can just ride it, right? Like if someone said, I don't know, that, hey, we're about to go into a recession, most people aren't worried about Coca-Cola. Most people are going to continue buying something that Coca-Cola owns. And because within their company, they have such a huge portfolio. And so you'll say, okay, well, Coca-Cola is going to be okay. But if you are a startup company who was just starting to get the revenue positive and then a recession hits, you may not have the reserves necessary to maintain your company and poof, you're gone overnight. So you will want to decide what that asset allocation is. Generally speaking, and I think I actually have some percentages and I'll place them up for you. If you have an aggressive allocation, you would be looking at about 60% in the US stock market, about 25% in foreign stocks, and about 15% in bonds. On average, over the last 20 years, that has generated about a 10% return, where the worst, which is the absolute worst 12 months, has been a loss of 61% of your portfolio. The absolute best return with that portfolio is 136% return on your portfolio. So you see that you have the chance to lose 61% or gain 140% on your portfolio. That was basically over the last 2 decades. And so you'll say, okay, how comfortable are you with that? So historically, the volatility is about 16%, which just means the up and the downs. The best 20-year return annualized is 16.5%. That's the best return. The worst 20-year return, because we're looking at long-term investing, I will tell you right now, anything you plan on investing in the stock market, you have to be comfortable leaving it there at least for 5 years. If you have less than a 5-year window, then we're not going to put that in the stock market. We could put that in CDs. We could put that in money market accounts, but we're not going to put it in the stock market. The worst 20-year return is about 3%, 2.66%. That's in the aggressive. On the conservative end of things, we have where 50% of our portfolio is invested in bonds, 30% of our portfolio is invested in short-term investments. That's going to be the CDs and the money market accounts. You have about 6% in foreign stocks, and you have 14% in the stock market. So that means overall 20% of your money is in the stock market, where it has the ability to get a reasonable to a high return, and you have the other 30% getting a smaller return in the short-term stocks, and then you have 50% of it in bonds, where about half of your money is generally safe, where they told you, look, you give me $1,000, I give you $1,100 back in 5 years. And you said, okay, that on average gets a return over the past 20 years of 5.93%, so about 6%. The worst 12 months in that scenario was a loss of 17%. The best 12 months was a gain of 31%. So you see how the loss was only at about 18% versus in the most aggressive, the loss was 61%. You also see in the best 12 months where the gain of 31% was compared to the gain of 136% in the more aggressive. Now, keep in mind that it is the 12 months. We're not putting a plan together where any 1 year is where we live or die by. We plan on putting the money at least for 5 years. And again, the worst 20-year average on the conservative investment was 2.9%. You see that? The worst 20-year average, naturally, your money is more protected. It was 2.9% versus the worst 20-year average was 2.6%. The best 20-year average was 10.98%. So that was about 11% on the conservative versus the 16.5% that we had on the aggressive. And what that means is if you're able to leave your money invested for at least 20 years, you have about the same risk, about 2.5%, 3% of what you'd expect to be the worst case scenario over a 20-year span. And that is between the conservative and the aggressive. But on the positive end, you can have 11% if you stay conservative over 20 years versus if you have a 16.5%. So you can get a much larger return, about a 5.5% return. And you can do that with about the same risk of about 2.5 to 3% on the worst 20 years. So if you leave your money in the long term over a 20-year span, the probability of you winning increases significantly. So once you have your asset allocation, now we're ready to choose the stocks that you're going to use. If you're going to take the approach of value investing, I'm going to go ahead and tell you 5 metrics that are worth having to decide that company. There are a variety of metrics and none of them are 100% guaranteed, but if you're focusing on preserving your money, then value investing is a great approach. You're going to choose great companies and wait for them to be at a discount, and then you're going to purchase those great companies. So those great companies are going to be there over the long term. You would look at things like your price to earnings ratio, and that metric helps investors determine the overall market value of a stock compared to the company's earnings. And it basically just shows you what people are willing to pay for this company based on past or future expectations of the return. The next one is the price to book ratio, and that just tells you whether the company, based on its price, is over or underpriced based on the assets that the company has. Now, this one is a great ratio, but you have to keep in mind, and sometimes people will subtract intangible assets. Now, there are some companies. So, for example, I've looked at Disney, and you will see that Disney has a pretty large amount in their intangible assets each year. And intellectually speaking, it's probably true. They have certain characters within the Disney princesses and Star Wars and Marvel and different things where they have an intellectual property, an intellectual value. It's not that they have land or buildings that they could sell, but they have the intellectual rights to these assets, and these assets are valuable. And it's true, these assets are very valuable for Disney. Obviously, Coca-Cola, their formula, that is like a company secret, that is their intellectual value. And the difficulty that we have with intangible assets is more times than not, when the company is going under, it's because nobody likes their intangible asset anymore. So the day that Coca-Cola disappears is because nobody likes the taste of it anymore. And so the intellectual asset, no matter how much we say the Coca-Cola formula is worth, when people decide they don't like it anymore, which I'm not saying that's going to happen, but they don't, it's like, okay, well, that was the value, and now people don't want to drink it, so what's the value? Same with Disney and them, right? If people decided they just hated Star Wars tomorrow, the intellectual value of those assets is about nothing because nobody wants to watch it. Now, granted, that's very unlikely to happen, but that's what we're talking about. You just want to be careful with the intangible assets. Always look at the assets and see how much of it is tangible, like a building and real estate, how much of it is intangible. And so you just want to keep that in mind. You want to make sure you know, because you can get burned by the intangible assets. The third thing that you want to look at for value investing is the debt to equity ratio. How much debt are they taking on to generate that profit? And if you keep track of this, it just is a warning sign for you to be able to say, okay, they're burning through cash. They're taking on a ton of debt. This is unsustainable. Maybe I should look for another company that doesn't have as much debt. A good rule of thumb is, can they pay off their long-term debt with their current assets in a year or 2 years? And some people may go higher than that, but you just want to be able to see how long would it take them to pay off their long-term debt based on the assets they currently have, the money that they're generating, and the things that they have going on. If it takes them a really long time, like they have a bunch of debt, then you may say, you know what, I got to get out of here. The next one, and what some people would consider the bread and butter in value investing, is the free cash flow. And it's a very fancy way of saying how much cash do they have left over when you subtract their expenditures. And if they have a good amount of cash left over, then that means it's a pretty good company. Some people will also use your free cash flow to project how much money they have. If their free cash flow grows by 5% every year, you would say, okay, well, this is how they have, $5 in here, and then it grows at 5% each year. How much would that be? And then you can decide how much that makes the stock worth based on some multiple of that. And you can say, okay, well, I'm going to go ahead and buy that. And the next one is the PEG ratio. So that one takes into consideration not only the price to earnings, but it adds growth in. And usually if you have a PEG over 1.5, then that usually means it's overpriced. If you have a PEG usually under 1, then it's considered under its value, where the company is generating more value than the price that you would pay to be able to purchase it. Now, normally I would look at each of these metrics within a 5-year span. So I want to see how they've been doing over the last 5 years. Are they consistently generating the revenue, or did they purchase a company and they just kind of inflated their books over 1 year? Are they taking on debt overall, or were they expanding their company? Like, how can I explain these things? Which is normally why you want to make sure you're choosing companies that you're interested in, which, as we go back to the Shark Tank example, why they do that. They are choosing companies they're interested in because you have to put in a good amount of work to make sure you're putting your money in the right place. If reading and learning about the company puts you to sleep, then it's not going to work very well for you. Now, if you're someone that's like, you know what, Dre, I have the time, I'm not scared of the stock market, I just want to get the highest return possible, then you would be looking at growth stocks. And if you're looking for growth stocks, those are normally going to be the ones that are trending in trending industries, where you may say, okay, I believe the metaverse is going to be the next best thing, Dre. Who is number one in the metaverse? I want to get on that company. You may say, I think that people are going to do more virtual trainings, more virtual work from homes. So I want to see who is the number one company in the work from home space. So you may say, I like Zoom, and you want to look at different companies. Who's the next Zoom? If you find the next Zoom who does it quicker for less, then you can say, all right, I'm going to jump on that because I believe this industry is going to be great in the next 10, 20 years. Where you see the difference between value investing and growth stocks, right? Value investing, we're looking for great companies and we're trying to find those great companies at a discount. For growth stocks, you're finding companies that are maybe borderline, like they have good bones, good structure, but I don't know if they're going to make it. They haven't made it quite yet. And you have to be comfortable in the long term because they may bust through in 1, 2, 5 years, but it may take them 10 years to bust through. But you have to find the company that you believe is going to be able to do that. And the 5 metrics that you normally look at in the growth aspect is, of course, your historical growth earnings, right? How have their earnings have been? Are they getting double-digit earnings over these years? Are they projected to keep getting double-digit earnings? That leads to the second one, which is your projected earnings. If the best years are behind them, then they're not a growth stock anymore. Now they're a value company where they're set. They are a staple. They have the market share. They're not doing any more of those innovations, right? That would be the difference between like maybe an Amazon or an Apple or a Google when they first started, where they were in the smaller cap size, under $2 billion, and you could tell that something was different about those companies. Now they're multi-billion, if not trillion-dollar companies. So you're not going to find them in the growth aspect anymore. Now they're on the value side of things. Some of them are paying dividends. Now some are still doing things, right? Don't get me wrong, but the biggest growth years are behind them. And then their profit margins. Normally, a good sign of a great company is they are able to dictate the prices in the market. If you're in a growth industry, you're looking for someone who has such an amazing moat, is what they call it, which is a very fancy way of saying they have some sort of a price differentiator. Walmart is the low price leader. That is their price differentiator. Apple is like the cool product, and then they have kind of the Mac and all that other stuff. And that is overall their price differentiator, where people are freaking out and they sit in lines overnight and everybody's always buying the stuff, right? That is how they set themselves apart in an industry. And as a result, they could charge more. And because they could charge more, they have great profit margins. And as a result of them charging more with great profit margins, you and I are going to be able to ride that wave as the owner of the stock. Nike is generally considered one of those where you have the Jordan brand inside of Nike, where you and I know that to make a shoe, I don't know, it's like $20, $30, $50 to make a shoe. And then you got J's that people are selling for $300, $400, and then they're reselling for thousands of dollars. That means that they are a price differentiator. They have some sort of a moat that gives them the ability to charge whatever they want because there isn't the ability to compete with them. And so you are looking at the profit margins to find those companies. If you find someone with, I'd say maybe over a 20% profit margin, then you can say, all right, if you're over 20%, then you must be dictating the market. What is it that you have that makes you special? And when you find what it is, if you like it, you can say, okay, well, this is on my short list of growth stocks I'm going to look at. If you can't figure out what it is, run away, because it may be a meme stock. I don't know. But if you can't figure out what it is that makes that company special, and even though they have a great margin, even though they have great projected growth, you just can't. You just can't, because you never know what will happen. The fourth one is return on equity, and that just shows how well the management is doing at creating a return on the money that people have invested in it. And so for that one, you just take the net income, which is your profits, and you divide it by the total equity. And that gives you your return on equity. If you have a good return on equity, you're normally going to be in that 15 to 20% range. That means that the money that people are investing in them, this management team is able to flip that money into a profit at a sizable return. If they're able to do that, then you're going to say, I'm going to give them more money, because if I give them more money, they're going to generate even more. The idea is if I give them $1 and they give me two back, then I'm winning. Every time I give them $1, they give me two back. I'm going to keep giving them dollars. But if every time I give them $1, they give me 50 cents back, and then I'm like, okay, well, let me just make sure I didn't mess something up. So you give them another dollar and they give you 50 cents back again. They're going to be like, okay, I don't know what's going on, but you're not getting any more of my money, right? Like if every time I give you $1, you give me 50 cents back, I can't give you any more money because we're both going broke. But if I give you $1 and you give me two back, then we're both winning, because I'm giving you the money that you need, and then you're flipping that money and you're doubling it or tripling it or whatever you're doing. So if someone has about 15 to 20%, you normally feel pretty good about that. And then the last one is the overall stock performance. And that can be seen in a variety of different ways. But for me, stock performance just means, have they been doing this consistently for at least the past 5 years? How do their margins, how do their profits, how does their sales, how does it look over the last 5 years? Are they consistently doing a great job? And if they are, then that is someone I would consider in my growth stock portfolio. Now, as far as diversification is concerned, you normally want to be in that maybe 20 to 30 stocks in your portfolio. And then you will choose them based off of the asset allocation that I have already given you. And once you have the asset allocation, you then find the stocks that fit in there. And from there, you build your portfolio. Now, once your portfolio is built, you have to know when to buy and sell. High level, you want to sell the stock if the reason you bought it changes. If you bought a company because you think their management is phenomenal, where they are killing it, and every time you give them $2, they flip it into $5, and you think that they are the brightest minds in the world, and then the management sells the company, then you should probably sell too, because the reason you bought that company has changed. If you think that the reason you bought the company is because everyone loves their product, where everybody's wearing it and it's trending and the stars wear it, and every time you turn on the TV, someone's wearing it, and it's like a cultural phenomenon, and then the culture changes, then you should sell the stock, because the reason you bought it isn't there anymore. If it is a government regulation where you are investing in, let's say, like natural gas, because the government is not over-regulating that, you left oil because there's so many regulations in oil. Well, if you woke up tomorrow and the government has added 50 new regulations into natural gas, then you should leave, because the reason you bought the stock has changed. That's number one. The second reason that you would sell a stock is you found somewhere better to put your money. If you have a stock in your investment that is generating a 10% return, and you find a company that is now generating a 20% return, and you feel good about the investment, where you go through the processes that we just went through, then you should sell your 10% return and buy the 20% return, and then hold on to that. If you're on the other growth aspect, and then the company's is not generating the same returns that you had bought it for, then now it's a value investment company, but you're a growth investor, then you should sell it, because now it's a value investment company. If you're a value investor and you said this company is actually worth $200 per share and it's selling at $150 per share, well, once the company gets up to the $200, then you may say, this company is worth exactly what I believe it is worth, so I maybe should ease off and sell the stock. Now, some people will just hold on to the stocks, but generally, if something changes within that structure, then you should look at selling the stock. You don't want to sell the stock just because the market is going down. You want to sell the stocks because the fundamentals of the investment, the fundamentals of that business have changed. And when that happens, you sell the stock. If you have somewhere better to put your money, you sell the stock. And then the third reason that some people would sell it is you need the money. Something has changed in your life where you need the money, and sometimes you got to do what sometimes you got to do. Now, there was an example, I think Warren Buffett talked about, where it was not him and just Charlie Munger, but where there was a third person who owned Berkshire Hathaway stocks. And that person ran into a hard time and sold the stocks to Warren Buffett, which obviously I'm sure that guy's kicking himself all over, because, I mean, come on, Berkshire Hathaway, it's a phenomenal stock. But situations happen, and sometimes you got to sell your stock. And that does happen. And if you don't have a plan B in place and you have to sell the stock, you got to sell the stock. And so usually those are the reasons that most people would find to sell their stock. The very last reason that you would sell your stock is if your asset allocation changes. So remember those asset allocations that we talked about where if you are conservative or you are aggressive, well, two things would change. One is as you get closer to your retirement, you should be shifting from very aggressive to slightly aggressive to moderate to safe because you have to preserve your money. You cannot be aggressive and be planning on retiring or achieving financial freedom and quitting your job in the next 5 years. Because if something happens, as we saw in the aggressive, you could lose 61% of your portfolio. And you can't let that happen in the last 5 years. So you would shift to a conservative approach, which means you have to sell some of your higher asset things and buy some of the safer things. You have to sell your aggressive stocks in the U.S. stock market, and then you would have to buy some U.S. bonds. You would sell some of your foreign stocks and the small cap stocks, and you would buy some of those short-term investments where you're putting your money in a safe situation. Now, sometimes your asset allocation will dictate you to have to sell them because your portfolio is out of whack, where you needed 50% of your money to be in the U.S. stock market, but for whatever reason, the U.S. stock market has been killing it. And so as a result of stocks going up and bonds going down, instead of it being 50-50, we'll say, you actually have 75-25 because the stock market is doing so great. So every time you put in $10 in there, $20 comes back to you. So now 75% of your portfolio is in the stock market, but then the opposite is happening on the bonds where every time you put in $10, 5 comes back. So instead of it being 50% stocks and 50% bonds, it's 75% stocks, 25% bonds. As a result, you have to buy more bonds and sell more stocks, which, funny enough, means that you are buying low and selling high. Because you are on the stock side, you're putting 10 and getting 20 back. So you're selling that extra 25%, which is selling high. You're selling at the peak of the market. And you're going to sell that extra 25% in the stocks. And then you're going to bring your stock investments back to 50% asset allocation. And then you're going to take that 25% profits and buy in the bond. So you're buying low because everything you put in $10 in the bonds, 5 comes back. Well, you're going to now spend that 25% and buy even more bonds. So that way you bring your bonds down from 25% back to 50%. You bring your stocks from 75% back to 50%, and then you bring your portfolio back in balance. So that removes the emotional investing, which obviously is very great. It does require you to be very confident in the research that you've done. You don't want to be putting more money and buying more in a loser because you're just wrong. But if you do have the fundamentals where you're like, I believe that this is a great company and they're going to bounce back because A, B, C, D, E. Well, then the emotion is out of it. And so you're going to buy more of that stock, which is, as I mentioned, exactly what most of us want to do. Most of us want to sell high and we want to buy low. But unfortunately, most of us, we do the opposite. We buy high and sell low because, right, a meme stock would be a great example where everybody's like, oh my gosh, we're making so much money. And you're just like, really? Is everybody making money? Really? Everybody's making money? And you're like, nah, I'm not going to do it, right? I'm not going to do it. I'm not going to do it. GameStop, whatever, I'm not going to do it. And then you look and like, oh my gosh, I bought it at $10 and now it's at like $300. You're like, what? Say what? It's at $300? Oh my gosh, I'm going to miss out on it. And then you go and buy it at the $300. And then the next day it's down to $150. So you bought high. And then obviously when it's at 150, you're like, oh my gosh, I'm losing everything. So you sell it. And then you've locked in that loss. You lost the money on that. So you ended up buying it high and selling it low. And so this approach just helps you on that. The last thing that you want to do when it comes to buying stocks, so you already know you have your investment philosophy, you have your overall risk profile, and you have the stocks that you're going to do, and you built your asset allocations. You know when you're going to sell it, and you're able to maintain that over the long term. The last thing that you want to do is just, hey, when you achieve financial freedom, what is your overall withdrawal strategy? When it comes to your withdrawal strategy, there's a variety of them. Some people do, maybe like the 4% rule. It's a very fancy way of just saying, I'm going to spend 4% of the money that's in my portfolio every year, and I'm going to have a 4% return. So I'm bringing in 4% every year, and I'm spending 4% every year. As a result, I should be able to live forever based off of that amount because I'm never spending the principal. Other people may not have the amount of money that they need to be able to live off of 4%, where 4% is like $10,000 a year, so they just can't do it. Another withdrawal approach is called the fixed percentage approach, and all that means is whenever I have the amount of money I have, so if I have $1 million, and I'm able to say, all right, I'm going to get a 4% return, so I'm going to live off of 4% this year. And then next year, my stock, for whatever reason, actually only got 3% return. Well, this year, I'm only going to live off of that 3%. And then next year, I have a 10% return. It was gangbusters. So then the next year, I'm going to live off a 10% return. So you have a fixed percentage return that is based off of the returns of your stocks. So while it ebbs and it flows, as a result, you're still not spending the principal, but you're actually maintaining a certain lifestyle based off of the interest that you can get on your returns. Now, this one, it's not as exciting for most people because most people want to be able to have a set amount. They want to know how much they're going to be able to get and how much they're going to be able to allocate towards their money. Obviously, that's why some people like annuities, because it gives them a set amount each year. And so a lot of people like comfort with that. You know, economically speaking, we all would love to get paid every week versus every month. It just gives us a little bit of certainty where we don't have to be planning and figuring out what we're going to do. So a lot of people do like that as well. Then the third one is your fixed dollar amount. And so you'll just simply say, look, with this in my portfolio, this is what I'm starting with. I'm going to live off of $40,000, and you may or may not adjust for inflation. You're just going to say, I'm going to live off $40,000 every single year, and whether my stock beats that or loses that, I'm just going to live off the $40,000. Some years that may mean I'm dipping into my principal. Some years that may mean I'm leaving a little extra because I made more than that. But you're hoping that it just kind of averages out to where you maintain the portfolio and you don't run out of money. Again, this just overall depends on what makes the most sense for you. The next one will be considered a systematic withdrawal plan, which is a very fancy way of saying you just live off of the income. If you have money that's coming in through interest in your bonds or dividends in your stocks, then you just live off of the income. Now, of course, this means that you have to have made that decision early on where a significant amount of your portfolio is allocated towards dividend-paying companies. But if you live off of the dividends, again, you're not living off the principal, and you even have some of your principal growing because you're only living off the dividends. So this may be the approach that someone would take if they didn't hit the number, but they're ready to retire, where they feel like, I'm ready to travel, I'm ready to do my own thing. So you may say, I'm going to start with my dividend income, and I'm not touching the principal, so my principal hopefully is still growing because the overall stock is growing, but I'm only living on my dividends. Well, maybe another 5 years, I'm only gonna live on my dividends for 5 years, my interest for 5 years, and then I have the amount that I need to now switch to one of those other strategies where you can say, okay, now I can live off of 4%. Maybe if you have a down market year where you'll say, okay, I'm gonna go back to living on just the dividends to give my portfolio a chance to generate the returns that it needs to maintain the amount so I don't run out of money. And the last one is called the bucket strategy. And normally the buckets, you have about 3 buckets. You have your short-term bucket, and that would be your money that you live off of. This could be your emergency fund. This could be your CDs and just your liquid money. So this would be like your CDs, your cash and savings, and any money market accounts that you have. This is the money that you're actually living on any given year. And then you have your moderate risk stocks, and you keep that in the middle bucket. And that is money that you don't plan on touching within a 1 to 3 year range. So whenever the best time is for you to be able to take the money out of that and replenish your lowest bucket, because that's the money that you're actually spending each day. Well, now you have like a 3 year range. So that way you're not locking in any losses where, all right, well, 2020 was a bad year because of COVID. As a result, I'm not touching my stocks. I'm just going to live off of the safe bucket. But we started growing and we started getting hyperinflation. I mean, for crying out loud, like there was that much growth. Well, within the 1 to 3 year span, you were able to now go into that moderate bucket because the money is starting to replenish as the stock market recovered. So then you're able to say, okay, well, now that that's growing, I can sell some of the stocks in my moderate bucket to replenish my daily living bucket. And then obviously the highest bucket is going to be your aggressive bucket. So that's the money that you touch the least often. This is money that's in a 5 to 10 year range. And you leave your money in there for the 5 to 10 year range. And whenever you have the ability in that range, you will sell them and you'll move that money into the moderate bucket. And so you'll just keep working the buckets to be able to live off of the lowest bucket. And then you're able to kind of work it from there. And then that's usually going to be the withdrawal strategies. So that is it for you. If you found value in this video, I gave you literally everything. I over-delivered as much as I could. If you want to achieve financial freedom through the stock market, you can start for as little as a cup of coffee, that $5 a day, $140 a month, and then you would be at about $1,800 a year. If you're able to commit to $2,000 every single year, you can become a millionaire. You can put this money together. And again, it's not like the majority of people, or even near the majority of people, are millionaires. Well over the majority of people are retiring today with 5,000 or less in their retirement account. 80% of people who are working are living paycheck to paycheck. And it's not that everyone's poor, it's that some people have a lot of money. I think I read a study that said about half of the people who make $100,000 a year are living paycheck to paycheck. And so you have a 6-figure job and you still are living paycheck to paycheck. If you can pay yourself first by investing the money in your future, then every time you put money in the stock market, you can buy one more day of your freedom. If that is something that sounds of interest to you, I invite you to come check out the Your First Stocks Challenge, which we will go over at 5 days. And by the end of that 5 days, you will have a complete investment strategy and you will have purchased your first stock and you'll be on your way to the path of financial freedom through stock market investing. If that is of interest to you, I invite you to go to yourfirststocks.com and register for the free 5-day challenge today.